Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everyone. Today is July 20th, 2026. Weekly Market Insights, Northbound Wealth Podcast, your host, Brent Foster. Thanks for tuning in. Stocks fell last week as chip stock trade entered a sell-off phase despite upbeat news on inflation. The S&P 500 index fell last week 1.55%, led by tech stocks, amid concerns whether excitement over artificial intelligence has been overdone in the U.S. While the NASDAQ Composite Index declined 2.9%, the Dow Jones Industrial Average slipped 0.93%. The MSCI EAFE Index, which tracks developed overseas stock markets, lost 0.80%. Chip stocks under pressure. The S&P 500 ended the week at 7,457.69 and is down 0.6% for July, but up 8.9% for the year. Worries about the U.S. technology sector flared as China's Moonshot AI, which is backed by Alibaba, released an AI model that says it outperforms some U.S.-based systems. Continued conflict in the Middle East also weighed as crude oil futures climbed. Iran said it had targeted U.S. military forces in Syria and Bahrain in a broadening of the scope of its attacks in the Middle East. Economic data showed that U.S. consumer prices declined by more than expected in June, while producer prices unexpectedly fell. The drop in the producer prices came amid a steep decline in cost of energy products. Still, U.S. industrial production rose by less than expected in June as manufacturing output stalled, Federal Reserve data showed Friday. The technology sector fell 3.8%, followed by a 2.4% loss in communication services and declines of 1.4% each in industrials and materials. Consumer discretionary and utilities also edged lower. The decliners in the tech sector included shares of Applied Materials, which fell 12% on the week, and Cadence Design Systems, down 14%. In communication services, shares of Netflix shed 6%. The streaming company's second quarter revenue missed Wall Street estimates, while third quarter guidance lagged market expectations. The company also said it will switch to releasing its engagement report annually rather than semi-annually. The upside energy climbed 5%, while real estate rose 2.3% and consumer staples added 1.4%. Financials and healthcare were also higher. Climate energy came as crude oil futures rose as Iran widened its attack to a desalination plant in Kuwait. Gainers include shares of Exxon up 6.1% and Chevron up 6.2% last week. This week's earnings calendar features Google parent Alphabet, Tesla, Philip Morris, GE Vernova, Texas Instruments, IBM, AT&T, Intel, and American Express, as well as ServiceNow, CSX Corporation, Moody's, Kinder Morgan, Marsh, 3M, Northrop Grumman, Danaher, Capital One, GE, Lockheed, Newmont Mining, Blackstone, Freeport McMoran, Comcast, Thermo Fisher, Union Pacific, RTX, and the Charles Schwab Company, Interactive Brokers. And that about rounds it out. There's quite a few companies reporting this week, so it's a busy beginning of the third quarter. All right, stay tuned for the next segment. Why SpaceX stock is sinking below IPO price. The stock settled near $124 on Friday, and it's below the initial public offering price of $135 a share. SpaceX made history on June 12th with the largest IPO ever, debuting at valuation near $1.75 trillion. According to its roadshow deck, SpaceX mission is to build the systems and technologies necessary to make life multiplanetary, to understand the true nature of the universe, and to extend the light of consciousness to the stars. At the same time, it says with this fundamental mission, progress in accessing space continues to yield opportunities that enrich life on Earth. While best known for its aerospace and rocket launch segments, the company operates across three primary verticals: space launch, Starlink connectivity, and artificial intelligence infrastructure. But the stock volatility post IPO reflects a growing debate on Wall Street. Is SpaceX the next trillion-dollar growth story, or has investor enthusiasm gotten too far ahead of fundamentals? Let's break down SpaceX and how it makes money amid its fall from the hype. Okay, so Starlink is SpaceX's primary revenue driver and its only consistently profitable segment, generating the bulk of the company's income. Starlink provides high speed, low latency satellite internet to over 10 million subscribers across more than 160 countries through over 9,600 low Earth orbit satellites. SpaceX provides broadband internet service to consumers, businesses, and governments worldwide. This segment delivers recurring subscription revenue. Space launch is the core aerospace foundation of the company. SpaceX generates revenue through commercial satellite launches, government contracts, and manned space flights. It has a 95% plus launch success rate, but this segment has faced challenges due to the high cost of development. The company scrubbed its last launch on Thursday after some engines didn't start, triggering an automatic launch abort. The launch is now scheduled for Thursday this week. Major customers include the National Aeronautics and Space Administration, or NASA, the U.S. Space Force, and the National Reconnaissance Office using its Falcon 9, Falcon Heavy, Dragon, and Starship platforms. Artificial intelligence. The newest and most scrutinized growth driver is SpaceX AI business. Following the integration of Elon Musk's AI assets, including xAI, the company now includes Grok, AI infrastructure, data centers, and enterprise AI offerings. SpaceX is leveraging its massive network to build out vast data centers capacities and AI compute services. The AI exposure is one reason investors initially awarded the stock such an aggressive valuation following the IPO, although it may also be the fact that Elon Musk heads the company. Although this segment uses a lot of CapEx spend, it may also provide the most revenue in the future. Even with the 45% fall from its post-IPO intraday high of $225.64, SpaceX market cap is still over $1.6 trillion. Looking ahead, several catalysts could determine where SpaceX trades over the next year: Starlink growth rates and profitability, execution of the Starship program and its potential for expanded revenue generation. In addition, AI infrastructure monetization is a key area of potential future growth. Its upcoming first post-IPO earnings report and guidance may also be a major catalyst. However, the August IPO lockup expiration could create additional selling pressure. S3 Partners last week said that short sellers increased their bearishness in SpaceX stock and hold 29% of publicly traded shares as a short position, which means they're betting that it goes down. The stock has quickly evolved into a sentiment gauge for both the AI trade and speculative investing. The company is not profitable and only generated trailing revenue of about $20 billion. The challenge for investors is still valuation. Some market analysts note that SpaceX is trading at an extremely high revenue multiple for a company that remains unprofitable. If Starlink adoption and AI revenues accelerate, bulls may argue the recent pullback is an opportunity. If growth disappoints and guidance is subdued, bears may continue to point to valuation as the primary risk. So it's a war between the bulls and the bears. I was reading a note over the weekend at JP Morgan has a price target of $225, which is basically 66% to 70% upside from here, from where it's trading actually today. So, and it happens to be around the intraday high of SpaceX at 225.64. So it's really close to that. And they're very constructive. They see that their price target, I think, expiration is the fiscal year end of 2027. So between now and the end of not this year, but next year, price target 225. So long term, maybe looking for better entry points. It's below the IPO price, so that's good. Anyway, some food for thought. I thought I'd share that with you. Some thoughts of my own, but intermingled and intermixed with Thomas White, who I follow on the Schwab network, does a great job. And he published that article out on July 20th. And I thought it was very, very good. All right, stay tuned for the next segment. Hey, everyone, this is your technical analysis spotlight. And I thought we would go through how other countries are doing. So let's take a look at Taiwan, South Korea, Colombia, Australia, Thailand, Italy, Singapore, Poland, Peru, Netherlands, Greece, Spain, Ireland, and the United States, then Canada, Norway, Japan. And so just taking a look at how high these countries are above their 200-day moving averages. So if you measure their indexes, it looks like Taiwan is 25% up above its 200-day moving average, but 4% or so below its simple moving average on the 50 day, and then about 5% below on the 20-day. They've had a couple of weeks on the downside as a correction. South Korea is 24.65% up above its 200-day moving average. Colombia, about 17. Australia, about 15. Thailand, about 13. Italy, 12. Singapore, 12. Poland, 11 to 12. Peru, 10. Netherlands, 10. Greece, about 9. Spain, about 9. Ireland, about 9. United States, about 7.82. Canada's 7.61. Norway, 6.58. And Japan, 6.35. And let's see. Hong Kong's about flat to its 200-day. China is about 6.99% below its 200-day moving average and trending up, though, looks like up today. So it's interesting to see where the countries are at. U.S. indexes, Dow transports, they're about 19.9% above their 200-day moving average, about 8.65% off their all-time high. Microcaps are about 6.25% off their all-time high, 12.97% above their 200-day moving average. NASDAQ 100's up 9.76 above its 200-day moving average, 5.96 below its all-time high. The NASDAQ Composite Index is up 7.79% above its 200-day moving average and about 5.28% below its all-time high. All-time high of 27,190. Currently trading around 25,754. Let's see. Jump down the Russell 2000. Up about 12% above its 200-day moving average, but close to its all-time high, just off 2.8% of its all-time high there at 302.72. Let's see. Dow Industrials just off its all-time highs at 53,289. That's down about 2.27% from all-time highs, but up 6.73% above its 200-day moving average. S&P 500 is 7.19% above its 200-day moving average, about 1.67% off of its all-time high of 7,620.90. Let's see here. New York Stock Exchange looks about the same, off about 1.52%, 5.41% off or above its 200-day moving average. So looks like the U.S. is in a bull market uptrend and maintains trading above its 200-day moving average. So do other countries tied to semiconductors and chip manufacturing and tech stocks. So here's some other assets that we don't talk about very often, except gold a little bit and Bitcoin a little bit. But let's take a look at these other assets. Bitcoin is trading around $65,000. It's had basically a weekly streak of 4 weeks to the upside off its lows. Ethereum has a similar story. The looks like gold over the past 3 weeks has declined. Now it's trading around $4,012 and potentially bottoming there. Silver, same thing. It's had one last week. It was up a little bit after a major sell-off and a couple of days to the positive. Copper is the same way. So copper is trading around $6.30. Silver, $56.99. And the US dollar is at 100.97. You got 1 week up, 3 days up of a strengthening dollar, which does explain a little bit why gold has sold off a bit. Bitcoin is catching a bit, Ethereum catching a bit after its major sell-off. So we track and watch a lot of the commodity complex. Overall, the commodity index has had 3 weeks to the upside plus 2 days. And so we have an index or a basket that represents that the commodity index or the grouping. So commodities are generally on the rise, so that'll be interesting to watch. We've got consumer price index around 3.23%, producer price index around 9.33%. So we'll be watching the inflation, CPI, PPI data. GDP is around 2.47% at the moment. We were up around 4.59, 5.38, 5.36, 6.07, then it dropped to 2.47. And that was across 2025 to 2026. Let's see here. US unemployment, 4.2%. The stock market, the S&P 500 continues to trade up. So we'll be continuing to track key economic indicators as we move forward through the course of this year. So far, constructive bullish. However, that can change with outside unknown geopolitical risks, potentially things. It's hard to model things you don't know. So we just only know what we know and can make predictions going out in 6 to 9 months. The stock market's a discounting mechanism, but I do think that things are constructive at the moment. And, we have a soft patch coming up and then probably going to have a good patch of news. And so long as the consumer remains resilient and strong and doesn't show signs of weakening or pulling back, I think that everything's going to work out and do well. Earnings continue to do well with these companies. So we'll be continuing to listen to what they have to say and track what they say on these quarterly calls to help make informed investment decisions as we move forward. All right. Thanks for tuning into the Northbound Wealth Podcast. We'll talk to you later. Have a great week and weekend, and like and subscribe. Thanks so much.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.